The following program is furnished by The Truth About Your Future, LLC. The views expressed do not necessarily reflect the views of this station. This information is education and not financial advice. Sponsors of the program pay a fee to be interviewed. See the truthayf.com disclosure page for details. Consult a financial advisor before investing.
The Truth About Your Future with Rick Edelman is brought to you by Global X ETFs, dedicated to providing investors with unexplored and intelligent solutions. And by Bitwise, a trusted guide in crypto has never mattered more. Connect with their dedicated team of crypto experts nationwide at bitwiseinvestments.com. And by Invesco QQQ, a fund that allows you to access the innovators of the NASDAQ 100, Invesco.com. And by Edelman Financial Engines. Rick Edelman is a board member, consultant, shareholder, and client of EFE, but EFE is unaffiliated and has no say over the content of The Truth About Your Future with Rick Edelman.
This is where technology, innovation, and personal finance come together.
This is The Truth About Your Future with Rick Edelman.
And now your host, Rick Edelman.
Thanks for joining me this weekend on The Truth About Your Future. Coming up on the show today, we're talking retirement, the aging population and birth rates, the investment strategy you need to exploit electric vehicles, plus a conversation with my wife, Jean Edelman. Well, you've heard the news. Average lifespans are falling. They fell again for the second year in a row. We're now only going to live to age 76 years of age, according to the CDC. And the reason for the decline, the pandemic and the opioid crisis. So I guess the message is don't get COVID and don't take opioids, as if life were all that simple. South Korea has got the worst situation regarding longevity. They have the world's lowest fertility rate. In 1970, women were producing on average 4.5 babies. Wow, 4.5 children per woman in 1970. Now it's 0.8. The average woman is not producing children. That is a real problem because you need women to produce on average 2.1 babies in order for the population to sustain itself. This is why the Korean population was growing so dramatically over the past 50 years, but now the Korean population is shrinking because women are having such few number of babies. 2.1 is the magic number. What's the number in the United States? 1.7. Our population is shrinking as well. As a result of all this, I don't know if you've noticed it, it's, might be hard to observe, but think about it. Schools have fewer students. The military in South Korea, for example, is expanding its eligibility requirements because it needs more people into the Korean army. There are fewer working age people. And this is a problem for older people because their pensions are dependent on younger workers putting money into the system. Fewer workers, that's less money going into the system. Lots of old people pulling money out of the system. This is why the pension crisis is a global one indeed. What are some of the strategies that South Korea is using to help offset this incredibly low fertility rate? They're investing in childcare, basically saying to moms and dads, we'll help pay for the cost of raising your kid. Something else they're doing, expanding job opportunities for young adults. They argue they're not making enough money to afford children. And along the way, the government wants to make housing more affordable. All of this sounds right? This is something we ought to be doing in the U.S., and I think a lot of people would argue we are doing this in the U.S. Invest in childcare, expand job opportunities, make housing more affordable, check, check, check. There's a fourth one, however, that South Korea is doing, which I think would raise eyebrows here in the U.S. South Korean government officials recognize the need to encourage immigration. If we can't get women to have enough babies, let's import them. Well, okay, not babies, but people. And that immigration issue is a hot potato in American politics. So if we can't produce enough people, we're going to have to get them from somewhere. Otherwise, our population will shrink, and that will create massive stress on our economy, a situation that is being faced by countries all around the world. This is a megatrend, and you've probably been ignoring it. How fast the population is aging. This is because old people are getting older, and we're not producing as many babies as we were before. In half of the world's countries, birth rates are falling below the replacement rate, as evidenced in the United States and South Korea. This is happening on a pretty much global basis with only a few exceptions. At the moment, we have more retirees. We also have fewer workers to support them economically, and that's a bad combination. The result of all this, the global pension shortfall is now $106 trillion, 3 times more than global GDP. Now, there are a lot of beneficiaries, though, from this changing dynamic. It's called the aging boom. Home improvement businesses are booming right now as older folks install handrails, redo their bathrooms, etc. Retirement communities are surging. Life insurance companies are benefiting because you're not dying with the frequency that we all used to. People don't die, the insurance companies don't have to pay off. By the end of this century, 90% of the world's workers will be coming from Africa and Asia, with an emphasis on India, the Philippines, Vietnam, and Indonesia. India already has 183 million more people of working age than Germany, France, and Canada combined. This is a huge opportunity for immigration, with huge implications for societies worldwide. By 2030, Gen Z will be the wealthiest generation. For 80% of them, the internet's older than they are. Their shopping experience is online. It has been their entire lives. They're only going to go to the mall if they have to. They don't use credit cards or cash. They use payment apps like PayPal and Venmo. Also, they don't drive. Half of them don't have driver's licenses. I mean, if your entire life is on your phone, you don't have to go to the mall to meet your friends. And for those born 2016, we haven't even invented 65% of the jobs that they're going to have. Now, you're familiar with blue collar and white collar. What's coming is green collar, jobs related to renewable energy, and also gold collar, jobs based on technology, space tourism, 3D food printing, biohackers, 6G, quantum computing. All that, by the way, going to lead to nuclear fusion and drug development. Today, it takes 15 years, tens of thousands of dollars to create a drug. Quantum computing will be able to do it in minutes, virtually free. We are going to see radical alteration of every aspect of society because of this changing, aging, demographic population scenario. This is, in the meantime, creating a huge staff shortage in nursing homes worldwide. We have so many old people need to move into the homes, and we have an incredible shortage of workers. So governments are trying to figure this out. The companies are trying to figure this out. In Japan, there's one solution that they've come up with. They're now hiring at nursing homes younger people to work. Babies, actually. Well, okay. They've got in nursing homes in Japan 32 children at one nursing home, all under the age of 4. The youngest baby worker is 2 months old. Okay, we're being a little bit tongue-in-cheek here, but I'm really quite serious. This is what they're doing. What are these little babies and infants doing in a nursing home? And they're getting paid, by the way? They're getting paid to merely spend time with the residents, who typically are over the age of 80. The parents bring their kids in, and the kids get paid in diapers and baby formula and free photo shoots, and the parents get free meals at a nearby cafe. The residents love the visits. The kids are allowed to roam around the nursing home, and the parents help them circulate. The kids decide when they're ready to go home, typically by crying. And the studies are showing, this is really very fascinating, social interaction reduces loneliness. It delays mental decline. It lowers blood pressure. It reduces the risk of disease and death. So this is a huge benefit for the elderly who are in these nursing homes. And the socializing across generations helps older people smile more, talk more. And for the children, the intergenerational interactions enhance their social and personal development. And all of this, improvement for everybody involved, is at virtually no cost. It's this kind of thinking where we're going to have to reimagine how we live, how we work, how we engage, because of the changing demographics that are occurring on a global basis. You need to make sure your investment strategy is focused on the future. The changing demographics are going to be altering the kinds of companies that profit and which of those companies are going to be the most successful. Make sure you're working with a financial advisor who's helping you focus on the future. Make sure your investment strategy is aimed in that way so that you have the portfolio that reflects the future you're going to be living in. I'm Rick Edelman, and this is the truth about your future.
You're listening to The Truth About Your Future with Rick Edelman. Thanks for listening to today's show, and thanks to Bitwise Asset Management for being our sponsor. Rick asked Bitwise to support the show because Bitwise has just one mission: to help you understand and access the opportunities in crypto. As crypto continues to grow in scale and complexity, a trusted guide is more important than ever. That's why Bitwise has built a nationwide team of crypto experts to help you. So take advantage of Bitwise's team. They work closely with financial advisors, institutions, and individual investors just like you. Talk to a Bitwise expert today or sharpen your crypto knowledge with Bitwise's awesome library of content. You'll find great help whether you're a crypto beginner or a financial professional. Crypto has major risks to consider, including the loss of your entire investment. So before investing in crypto funds, visit bitwiseinvestments.com for their library of content and to learn about the risks with these investments. That's bitwiseinvestments.com.
What do all the greatest innovations have in common? Agents of innovation. Ordinary people who shape the future by putting their money behind the right ideas. Invesco QQQ is a fund that allows you access to innovators of the NASDAQ 100. So you don't have to be an inventor to help create what's next to come. Be an agent of innovation with Invesco QQQ. Learn more at Invesco.com/QQQ. There are risks when investing in ETFs, including possible loss of money. ETFs' risks are similar to those of stocks. Investments in the tech sector are subject to greater risk and more volatility than more diversified investments. The NASDAQ 100 Index comprises the 100 largest non-financial companies on the NASDAQ. You can't invest directly into an index. Before investing, carefully read and consider fund investment objectives, risks, charges, expenses, and more in the prospectus at Invesco.com. Invesco Distributors, Inc.
When your health diagnosis isn't going according to plan, you likely seek a second opinion. It's time you treat your wealth the same way. Get a new perspective, new information, a new diagnosis for your investments. Get a second opinion from a wealth planner at Edelman Financial Engines. Our dedicated planners offer personalized advice and are ready to talk one-on-one. Our approach is backed by institutional rigor. We model over 38,000 securities monthly, so we can better stress test your portfolio through thousands of scenarios. So, take a deep breath and take care of your wealth like you take care of your health. Get your complimentary wealth checkup today, where you can discuss your financial plan with a wealth planner. Call Edelman Financial Engines at 888-899-4450. That's 888-899-4450. Or visit planefe.com/Rick today.
Listening to The Truth About Your Future, I want you to tell me what the following automobile manufacturers have in common: Audi, BMW, Cadillac, Chevrolet, Fisker, Ford, Genesis, GMC Hummer, Hyundai, Jaguar, Kia, Lexus, Lucid, Mazda, Mercedes, Nissan, Polestar, Porsche, Rivian, Subaru, Tesla, Toyota, Volkswagen, and Volvo. What do they all have in common? All of them are making electric vehicles. Everybody's making electric vehicles these days, and the White House says that it wants half of all the cars sold by the end of this decade to be electric vehicles. The global electric vehicle marketplace is going to reach nearly $1 trillion by 2030. That's 18% annual growth. So far, Only 3% of new cars sold are electric vehicles, but it was a jump of 40% over the past year. Very few cars are EVs, but it's growing incredibly rapidly, and we're talking 18% annual growth rate. And by the way, guess who else is rumored to be launching an electric vehicle? Apple. The Apple car is rumored to be coming onto the market in 2024. So if this marketplace is growing at an exponential rate, that's the whole idea of exponential technologies, right? With strong double-digit annual returns projected, how can you capitalize on this as an investment strategy? Well, I'm going to give you 3 ideas. First, the Global X Autonomous and Electric Vehicles ETF. The symbol is DRIV, drive. This is the largest pure electric vehicle ETF on the market. It's got $1 billion in assets already, demonstrating how popular it is among investors. Its top holdings include Apple, Toyota, Alphabet, Tesla, Intel, Honeywell, Qualcomm, NVIDIA, Microsoft, and Allegheny Technologies. Technology stocks as well as automotive stocks. But here's the thing. Not only is the growth in electric vehicles and autonomous vehicles going to grow dramatically, there's another growth area on top of that. And that is the fact that we're going to need 600,000 metric tons of lithium to power all of those vehicles. By 2030, we're going to need 3 million metric tons, 5 times more than our current needs, because there are going to be so many more electric vehicles on the road. Lithium is a rare earth metal. It's not readily available like sand. And as a result, with the limited availability, the limited supply, with an increased demand, the marketplace is widely expecting lithium prices to rise significantly over the next decade. So how can you capitalize on that? If you believe in investing in electric vehicles, then you have to, by definition, believe in investing in lithium. How? The Global X, Global Lithium and Battery Technology ETF. The symbol is LIT, L-I-T. It's one of the country's first thematic ETFs and by far the largest pure play lithium ETF on the market. This fund was launched back in 2010. It's 12 years old now. It has $5 billion in assets under management, demonstrating for you the broad array of people who own it. And it gives you exposure to the full lithium cycle, companies involved in mining it, refining it, as well as battery production on a worldwide scale. So you've got the electric vehicles and autonomous vehicles. That's one ETF, Drive. Now you've got the lithium ETF, LIT, which allows you to invest in the pure lithium itself that allows those electric vehicles to operate. And finally, the third ETF, what are all those cars going to drive on? Roads. Well, traffic congestion costs our economy $120 billion a year. 25% of our bridges are deficient. 14% of them are functionally obsolete. 20% of our flights were delayed last year. Overall, the American Society of Civil Engineers gives our nation's infrastructure a grade of C-. Well, coming along is the Infrastructure Investment and Jobs Act, providing $1.7 trillion in new funding for roads, bridges, power grids, passenger and freight rail, broadband, water infrastructure, airports, ports, and waterways. Half of this money, half of this $2 trillion is going to be dispersed within the next 4 years. So as an investor, how can you capitalize on that? And here's the third investment opportunity that I suggest. The Global X U.S. Infrastructure Development ETF. The symbol is PAVE, P-A-V-E. Pretty clever names, eh? Drive, LIT, PAVE. PAVE is the largest pure-play U.S. infrastructure ETF on the market, $4 billion in AUM. Its top holdings include John Deere, CSX, Union Pacific, Nucor, Alcoa, and U.S. Steel. If you are interested in investing a portion of your portfolio in the concept of transportation, investing in electric vehicles, the lithium that powers them, and the roads they'll drive on. Those three ETFs, Drive, DRIV, Lit, LIT, and PAVE, PAVE, are three ETFs from Global X that I think give good exposure to this sector of the marketplace. Gene and I own all three of these ETFs, and we believe it makes sense as part of a diversified portfolio, and so I wanted to mention them all to you. You can go to globalxetfs.com to learn more about them, or talk to your financial advisor about the Global X Autonomous and Electric Vehicles ETF, symbol DRIVE, the Global X Global Lithium and Battery Technology ETF, LIT, and the Global X U.S. Infrastructure Development ETF, PAVE. I'm Rick Edelman, and transportation innovation is in our future, and that's the truth about your future. You're listening to The Truth About Your Future. I'm Rick Edelman. Very happy to tell you, if you missed the news so far, that starting in January, this weekly radio show is going to become a daily podcast. Same content, same great guests and interviews, and I invite you to listen to the daily podcast, and you can subscribe to it right now. Just go wherever you get your podcasts, iTunes, Spotify, Apple, Google, and of course my website, thetruthayf.com, giving you all the information you've grown to love that I present to you every week for the past 32 years. I'll continue doing that for you, but starting in January, as a podcast. My new podcast, it's free. The Truth About Your Future with Rick Edelman, wherever you download your podcasts. Got a lot more to share with you today. Stay with us for more here on The Truth About Your Future.
The Truth About Your Future is sponsored by Global X ETFs. You tune in every week to hear Rick Edelman tackle the personal finance topics that matter most to investors. And this year, what matters most is market volatility, stubbornly high inflation, and rising interest rates. It's been a lot to grapple with. At Global X ETFs, our income-oriented strategies can be an appealing way to help you position your portfolio during this period of uncertainty and volatility. Our approach goes beyond bonds and traditional fixed income investments. We focus instead on asset classes that offer you income-producing potential that you may not have considered, including MLPs from the energy sector, real estate investment trusts, preferred stocks, covered call strategies, and dividend-paying stocks. We've been providing investors like you with income-oriented investments like these for more than a decade through both bull and bear markets. Come, explore our full range of ETFs and look at our research and more at globalxetfs.com or talk with your financial advisor. Global X ETFs.
The Truth About Your Future with Rick Edelman is sponsored by Charles Schwab. Schwab's passion for serving clients is more than standard practice. It's part of who they are. With transparent pricing, 24/7 live support, and a satisfaction guarantee, the people at Schwab go the extra mile to help you on your investing journey. They're not just financial people, they're people too. Learn more at schwab.com/whyschwab. That's schwab.com/whyschwab.
You're listening to The Truth About Your Future with Rick Edelman, sponsored by Choice. If you want more control over how you invest your money, you need to check out Choice. Choice makes it easy for you to invest in Bitcoin and other crypto assets in your retirement account. You can transfer your existing IRA, roll over an old 401k, or start fresh with a new investment. There are no hidden fees or account minimums, just more choice in how you invest your money. You can open a deductible or Roth IRA and invest in Bitcoin, crypto, stocks, ETFs, gold, real estate, and more, all in a single account. Don't let your old bank or brokerage firm limit what you're allowed to invest in. Do what Rick did and take control of your future by heading on over to retirewithchoice.com/Rick. That's retirewithchoice.com/Rick, or simply search Choice IRA in the App Store or Google Play Store on your iPhone or Android device. It's your money. It should be your choice. retirewithchoice.com/Rick.
Please join me in welcoming onto the program my good friend Sean Wintz. He is Executive Director of Financial Planning at Edelman Financial Engines. Sean has been in this field for 25 years. Prior to that, he was a decorated Navy vet. My good friend Sean, welcome to the show.
Thank you. Thank you for having me, Rick. It's a pleasure and an honor.
I really wanted to have you on today because, Sean, we were talking offline, and I said, I got to bring you on the show to talk about this because the market is so uncertain right now. There is so much volatility going on and there's so much unease, everything from Russia and Ukraine to the energy issue, to the inflation issue, the market's in turmoil, rising interest rates. I mean, we know the drill. I don't have to go through the whole list, although I think I just did. Everybody's worried about their retirement security. And you're on the front lines. You deal with hundreds of clients. You're managing hundreds of millions of dollars in assets on behalf of so many people who are so focused on retirement security. What can people do, Sean Wintz, to help people improve their situation in today's environment?
I think one of the critical aspects is to understand retirement, understand where you are in the process and in the cycle. Are you 40 years old and just starting to get into the peak years of earning where you can accelerate savings, or are you toward the tail end getting into retirement or retired? And I think, as you've always said, as we've always practiced at Rick Edelman, it's still a long-term approach, and it's still stay the course. Find a well-diversified portfolio, stick with it, save, stay out of debt, keep cash as a mitigating force against what we call and study the sequence of return risk, because that's what we're fighting, and to keep a solid eye on your investments, what they're doing, how they're doing them, but to not change just because we're facing some volatility in the market and uncertainty. Life is always uncertain. Markets are always uncertain.
You mentioned sequence of returns. What is that?
That is basically the sequence of return. Where am I in the cycle, and where am I using my money as far as what is my drawdown? When do I need my funds versus where are my funds? What is the return of my funds? What's the market return? What's my portfolio doing? And do I need a drawdown? Am I drawing down now? And that drawdown, that pulling money out of markets at inopportune times, let's say when markets are moving down, is the sequence of the return over a course of time. And that's what the retiree really worries about. You'll hear, I can't retire this year because markets are down. And we'll take a look at it and I'll say, well, you have enough of a pension, you have enough with Social Security that even in a down market, you're okay. And there are those conversations where, no, you cannot retire.
And that is the question, isn't it, that you're getting often? People asking, do I have enough money to retire? What's your answer? That
is the question. It depends. Do you? And we take a look at that. And so again, it goes back to that, what is the liability matching that I need? What do I need as a monthly, quarterly, annual amount of money to live on, to keep my quality of life and remain stable through that quality of life? Many studies have shown those 65 to 74 spend less than those 60 to 70. But I still need this large pool of money that I can live on the interest and earnings of that. So I have to match that with what I need monthly as far as to service my debt. My discretionary is always a pleasure, but my non-discretionary is critical. And so we start there. What do you need monthly? What do you need annually? And how does that pan out? And we back investing and planning into that number.
And how often do you discover when people come to you saying, gee, I'm not sure if I have enough money to retire, that you go through their numbers, you look at their income and expenses and their assets and so on. How often do you discover that they were right to be worried? They don't have enough money to retire, as opposed to being able to say, oh, you're fine. You're in surprisingly good shape, better than you thought. How often do you find people in those two different camps?
I would say it's probably a 60-40 split, those that can to those that can't, and maybe 50-50. Demographically, I'm in a great region. I'm in a high-earning, highly educated, high-earning area. My demographics are pretty good. But with that being said, I still have, I'd probably say a 50-50 split.
So obviously the half of those folks who get the thumbs up, congratulations, good for you, pat on the back, keep doing what you're doing, that's easy conversation. It's sort of like going to the doctor. If you don't have cancer, that's an easy conversation. The tests are negative, good for you. But what do you say to the other half where they really don't have enough money to retire? That's a pretty tough conversation to have, isn't it?
It is a very tough conversation to have, but I also think it's a critical one. I look back at my mother, and God bless her, she didn't have that conversation and didn't know what she was careening toward. And so I think it's really critical to get that sort of course correction in for them. It is a tough conversation. It is a conversation where you're ruining someone's dreams, where they have fantasies of the beach next year, and you're telling them that's probably not going to happen.
All right, if running off to the beach next year is not going to happen, how horrible is the situation? I mean, what generally are you able to say to them? Is it just a couple of tweaks, work another year or two, or are you telling them they're never retiring?
It's always a funny thing because it's a broad brushstroke. So some are a couple of tweaks. Some, hey, get rid of some debt, save a little more. Let's accelerate the savings. You have a lifestyle that you can change. Others are just, there are probably, of that 50, there are probably 10% I would call that hard case, that it doesn't look very good, and we're going to have to extend your working period out 5-10 more years because there was no planning there, and it's just impossible. The numbers just don't make it.
Or they're going to have to make a radical shift, such as moving to much lower cost housing.
They're going to have to either get low, which means whatever that is, we are going to have to give them a plan to get low, where you're going to need to sell the house, move to the middle of nowhere, North Carolina, or wherever it is, move in with the kids. That's all. There are those conversations where it's just not feasible. Or in addition to get low, you're going to have to also get low and work a few more years.
Let me give you a takeaway from this that I'm hearing, and I want you to address what I suspect many of our listeners are thinking, Sean. You're describing that roughly half the time, people who come to you are in great shape economically, and that's wonderful. But half the time they're not, and in some small portions of those, you're going to give them a really set of bad news. Extreme. I mean, people aren't going to want to hear that for sure. It's sort of like saying, I'm not sure if I'm feeling that well. I really don't want to go to the doctor because I'm afraid of what the doctor is going to tell me. I'd rather be in the dark. I'm afraid to face my situation. What do you say to folks who are listening to us right now who are like, I don't know if I want to go to a financial planner. I'm not sure I want to hear what they have to say. What's your response to that?
The reality doesn't change, and the information will help you change some of your reality. That's the powerful piece. Whether you hear it from me or not, you are set on a course that's going to fail. So let's get you the information, and armed with information, we can possibly have at least a better shot at a better outcome, increased probabilities of success versus careening blindly into failure. I think it's you have to face reality. If not, reality faces you.
And the sooner you do this, the better off you're going to be. The sooner you do this, the easier it is to make those changes.
Exactly. When's the best time to start a diet? Yesterday.
Well said. Everything is best yesterday, whether it's quitting smoking, going on a diet, starting to exercise, starting to save. The best time is always yesterday. So let's do the second best thing and do it today. All right. So another question that you're getting an awful lot, I'm sure, considering we're in a recession, whether it's official or not, we're feeling like it's a recession. People are facing the opportunity to retire, but that means the no more paycheck from work. And that means they're going to be dependent on their investment income, pension, Social Security. So should you, all other factors being equal, you can choose to quit your job now and retire. Should you, or should you keep working until the economy stabilizes? Should you retire during a recession?
It is, again, dependent. All blank statements are wrong, but it is dependent on assets, income needs, and also health, and the kind of non-quantitative health and quality. Are you just miserable. And can we retire? And can it be that we're going to need to get low for a little while in a recession? But I look at it quantitatively and qualitatively. Quantitatively, do the numbers support it? And then qualitatively, are you miserable? Are you going to sit at that desk and die? Is that going to be, are you just not having fun anymore? Now, of course, the numbers have to support it because feelings are just feelings if you can't do it. But yes, you can retire in a recession. It is still dependent on your assets, your savings, your debt load.
And so the message I'm hearing from you is don't assume you shouldn't or can't retire during a recession. Don't make that assumption. Talk to a financial planner and let's get the question answered for your own personal circumstances.
Exactly. Therein lies the rub. Talk to a financial planner, get the numbers, crunch the numbers, take a look at it and see because the other thing you find, and you've seen it in your many years, is people don't know the number. They don't know what they need. And so as a non-professional trying to figure it out with kids and everything else, trying to get from point A to point B, it's something most of us don't do. And it's critical to go talk to a financial advisor and see what that number is and where you are in the queue.
It's funny, you mentioned that most people don't know how much they're going to need. I would also argue they don't even know how much they have. It's amazing how oblivious so many people are about the how much they're worth, how much money they really do have. They haven't really looked at it seriously.
Whether positive or negative, they don't understand it. Because again, for the most part, we're teachers, lawyers, doctors, something else, doing something else, trying to get the kids to school.
All right, let me shift over to those who are already in retirement. These are folks who have money in a lot of places. They're getting Social Security. They have money in a 401k or other retirement plan at work, a 403b or a thrift savings plan or what have you. They've got brokerage accounts and IRA accounts. They got bank accounts. They have, money in lots of pockets all over the place. And they have resources available to them in a variety of ways. And they're in retirement. They need income. Where do they draw that income from? Which account do you take from first?
We take a look at it and we take a look at their taxes. It's an interesting, we want to be as tax efficient as we possibly can in the accounts. So for example, I have retirees, 2 retired admirals that are married. Anything coming out of their IRA is ordinary income, so they're delaying that. Unfortunately, they're delaying it knowing that they're going to pay RMDs later on, but they're hoping to give money away and other things, but they almost don't need any funds from their account, so they're doing $100,000 each in pensions, and they spend $3,000 a month. That's a rare and nice case. Those that we start with the most tax efficient of accounts, and we take a look at how what they have between Social Security and their pension income, if pensions are available. If they have only an IRA and they need the assets from an IRA, then it becomes a pretty straightforward conversation and they have to take the assets from the IRA. But we're going to start with the most tax efficient method for them.
And it's not merely tax efficient for this year, but on an ongoing long-term basis, what's long-term tax efficient? Because a good decision this year might prove to be a really bad decision in future years.
Exactly. Are you selling your home next year and moving to the Carolinas where you're going to have a large capital gain in the home and you're taking ordinary income, or you're taking capital gains? Or is it a good year can you pre-RMD have the flexibility to choose the pool of money to take from based on your taxes? It's like you said, on a long-term going forward basis, because it's going to be something. Another plot or plan is we're seeing people do things like conversions or taking money from the IRA earlier because they know their RMD is, with a large pension, the RMD is going to push them into a higher tax bracket. It's critical to talk to a financial advisor and see what's needed, which way makes the most sense for you, the most efficient.
And related to all of this, of course, is how that money is invested, because you probably have different investments in different kinds of accounts. In the bank, you probably have CDs, whereas in your brokerage account or 401k, you might own stocks. So how do you know if you have the right investments in the right accounts? How do you know if your money's properly invested?
Well, again, sitting there, taking a look at your overall I hate to use a jargon, but the asset allocation. How am I spread out? How is it spread out? How is it serving me? What do I need in short-term cash, and where should that be? What do I need based on the interest rate environment, the current market returns, but more importantly, my income needs and my taxes. So we will take a look at that. Again, you'll sit down with a financial advisor and take a look at your asset allocation, your investments, and where the pools of money are situated and what may need to, again, another course correction. Do I need to take money out of the CD because it's not serving me? And do I have time to maybe get a little more tax deferred growth? Or in retirement, is it best that I pull money from, in the current market environment, that I pull money out of savings versus pulling money out of the market, since it's down to do the small home to refurbish the kitchen? So we have to take a look at it all again on a case-by-case basis, sitting down in front of a financial advisor, going over it all with you.
We're talking with Sean Wintz. He's Executive Director of Financial Planning at Edelman Financial Engines. Sean, we talked earlier about the fact that a lot of folks are in great financial shape when they come to you, and others are not. Let me put it in a different context, in the area of risk. When people come to you and they show you where their money is invested, are you discovering that people are taking more risk than they should, or more risk than they realize they're taking?
Absolutely. One of the, I think, tenets, especially the last couple of years, where we had some pretty good, some would say, outlying market returns. Folks, risk tolerance is a relative thing. Markets are doing well, I can take more risk. And so that's what we're finding. People were taking much more risk than they should have, because markets were up. And they didn't realize that when markets come down, that risk also, that risk plays into volatility. And that volatility is what is going to harm you when you need to take a fixed amount from the portfolio. So yes, much more risk than they should.
And when you tell this to folks, what's their reaction?
The reaction in this current market is like, yes, because markets have moved down. Overall, when markets were moving up, they were like, I don't believe you. Why take less risk? I have a funny example. It's years ago. It's during the .com era. I had a client come in, and it was an old fund that I won't name, but it did 125%. And I said, you're taking too much risk. You have to get out of it. We need to put 20% of bonds in your portfolio, diversify large cap, mid cap. And he said, you're out of your mind. And then a year later, he came back, and it was half the value of the portfolio, and he understood risk. Too much risk.
It's easy to be up when you're up. The trick is to be up when you're down.
Exactly.
And one final question for you, Sean. Social Security, that is a huge item for every retiree. The fundamental question, the most important about Social Security, when should you start?
Again, a question that you have to sit down and plot and plan and take a look at, devise an overall plan. There's a quantitative and qualitative piece. All numbers show quantitatively, if you wait, you get more. And that's generally most of the conversation. But there are those situations where, one, it's an easy one. If you need the money now, then you have to take it. And then it becomes lifestyle, life support, other things, your health, spousal support. Does it make sense? Who should start? Who should take it? Who's going to have a larger one? Should that one go till 70? So again, it's a conversation that we definitely can have and solve for you, but we would need to have it and solve it for you.
All of these issues explain, I think, pretty eloquently the value and the importance of talking with a financial planner. Sean, if somebody wanted to reach you or your colleagues at Edelman Financial Engines, how would they do that?
You would go to planefe.com/Rick.
That's Sean Wintz here on The Truth About Your Future. He's the Executive Director of Financial Planning at Edelman Financial Engines. And as Sean said, if you want to reach him or his colleagues, visit planefe.com/Rick. Sean, thanks for being with us on the show.
Thank you, Rick.
Stay with us for more here on The Truth About Your Future.
Allow us to introduce you to Sabrina, an ordinary person who helped shape the future by putting her money behind the right ideas. Each morning, Sabrina enjoys a 20-mile bike ride and meditation that brings her serenity for the day to come. Sabrina is also accessing the companies that are revolutionizing the tech world by investing in Invesco QQQ. Invesco QQQ is a fund that allows you access to innovators of the NASDAQ 100, which goes to show you don't have to be an integrated circuit engineer to help push progress forward. Become an agent of innovation. Learn more at Invesco.com/QQQ. There are risks when investing in ETFs, including possible loss of money. ETFs risks are similar to those of stocks. Investments in the tech sector are subject to greater risk and more volatility than more diversified investments. The NASDAQ 100 index comprises the 100 largest non-financial companies on the NASDAQ. You can't invest directly into an index. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Visit Invesco.com for a prospectus with this information. Read it carefully before investing.
Afraid to look at your financial statements? Shredding them without opening them? It's time for a second opinion from Edelman Financial Engines. Our opinions aren't based on intuition or daily market movements. They're grounded in institutional rigor, and all of our planners are fiduciaries who put your interest above all others. So if you need help managing the ups and downs of this market, we're ready to talk. At Edelman Financial Engines, you get personalized investment recommendations from a dedicated wealth planner who doesn't sell products to earn commissions. So stop shredding those financial statements. Let's take a look together. It's time to get a second opinion. Get your complimentary wealth checkup where you can discuss your financial goals with a wealth planner. Call Edelman Financial Engines at 888-899-4450. That's 888-899-4450. Or visit planefe.com/Rick today.
The Truth About Your Future is sponsored by Global X ETFs. You tune in every week to hear Rick Edelman tackle the personal finance topics that matter most to investors. And this year, what matters most is market volatility, stubbornly high inflation, and rising interest rates. It's been a lot to grapple with. At Global X ETFs, our income-oriented strategies can be an appealing way to help you position your portfolio during this period of uncertainty and volatility. Our approach goes beyond bonds and traditional fixed income investments. We focus instead on asset classes that offer you income-producing potential that you may not have considered, including MLPs from the energy sector, real estate investment trusts, preferred stocks, covered call strategies, and dividend-paying stocks. We've been providing investors like you with income-oriented investments like these for more than a decade through both bull and bear markets. Come, explore our full range of ETFs and look at our research and more at globalxetfs.com or talk with your financial advisor. Global X ETFs.
You're listening to The Truth About Your Future. You know, every week about this time on the show, we bring in your favorite segment, a visit by my wife, Jean Edelman, here on the show. But we've gotten a bunch of requests from folks because, as you've noticed, you know, every week I interview people on the show, and every week Jean appears on the show, but I've never interviewed Jean. And they've often asked, we're getting folks saying, Rick, you should interview your wife on the show. So, hi, Jean.
Hi, Rick.
So let me give you a little bit of background. Jean and I, of course, jointly founded Edelman Financial Services back in 1986. The company now Edelman Financial Engines. We left the firm last year, and we worked together for 35, 40 years in building the company. Jean, you had pretty much every job was.
Yeah.
In the business. You were the first everything.
Yeah.
First receptionist, first HR, first compliance.
Facilities, everything.
Yeah. And so what a lot of folks have said to us over the years is they've seen us at seminars and events and so on. They've said, I could never work with my spouse. Mm-hmm. And it was natural for me because I grew up in an entrepreneurial household. My mom and dad ran their own small business. And so dinner conversation was always about what's going on in the company. So it was very natural for me to assume I would work with my wife because I grew up in a household where dad worked with mom. But that wasn't your background.
No, we were traditional. Dad went off to work. Mom took care of the kids. Mom eventually got a job But
only when the kids were grown, all in school.
We were all in high school.
Yeah, but there were four of you.
There's four. I'm the oldest of four. Yep.
And Dad was that real classic, get on the train into the city.
We lived in Cranberry, New Jersey, and my dad would commute to New York every day.
And he worked actually in the Empire State Building.
Yes, he did.
Which is really very cool.
Yeah, very cool.
So what was it like for you then when we first started working together, building this tiny little company that grew?
Well, I think we work well together because you were always the visionary and I was always the detail person. So we never really got in each other's way. I always you needed something done, I always figured out how to get it done.
So the way I always phrase it is that I would create the problems and Gene would solve them.
Yeah, to put it nicely.
And so that's, I think, a key element in any relationship really is recognizing each other's strengths and preferences. Where do you want to spend your time and how do you want to do what you're doing, and have a lot of respect for each other. I never had to tell Gene how to do it, nor would you tolerate me telling you how to do it.
I mean, it was natural for me to, I was very good at figuring processes. I set up all the systems in the company. I think they still use some of them.
So I'll never forget one of the most memorable occasions we had when we were first raising capital for the first time in 2005, and we're meeting with investment bankers. And you can envision what this is like. You've seen this. Remember the movie Working Girl? And she shows up at this meeting with these investment bankers, this massive, huge round table, and 30 men sitting around this table, and with thick books of charts and graphs and legal documents. That's what doing a deal on Wall Street really is like. And we went to a lot of those meetings when we were raising capital back in 2005 for the first time. And it was so funny. We go into this meeting and there are all these suits hanging around, and we're sitting there, just Gene and me, and the suits said, "Where's your finance department?"
It was just me.
I just was like, yeah, you're looking at her.
I mean, we had 7 companies at the peak of our business, and I did all the commission work. I did all the banking, all the accounting. It was
just Gene.
Just me.
So people used to joke, why is the company named just, after me? And I'm like, no, you got it all wrong. It's the Edelman Financial wasn't named after Rick. It was named after Gene Edelman. And she let me work there. And so it was always a lot of fun doing this and building the company. And as it grew, we kept firing you. We kept moving you to other jobs because I had to have you stop doing this and start doing that as new needs and opportunities came up, and you just did whatever it took.
The fun part in the beginning was because I was the receptionist, so I knew all the clients' voices and I knew their kids, and I think that was I think that's why our clients stayed with us, throughout their process, because it was like a family, and we kind of grew up together.
Well, you were the glue. I mean, they would call to talk to you. They didn't want to talk to me so much. So, because you were and remain the heart and soul of the business. Gene, we affectionately refer to as the office mom, and so I'm not sure it's a great analogy. Maybe I'm the brain of the business, but you're clearly the heart and soul, and that's far more important. Yeah. But beneath all of it was the fundamental desire for you and me to build a financial planning business. It wasn't just a business. We backed into building a business. The real focus for us was financial planning and helping others improve their finances. Right. Everybody knows my story because I talk about it often on this show and in seminars and all my books of why I cared about that. But talk about your journey in this, Gene. Why did you care about this? Why was financial planning so important to you?
Well, it was more the education because, when we were very young, we wanted to buy a house, and Rick went to a financial planner because he would only meet with Rick, and that was the first wrong, and then he told us something that was illegal to lie on our mortgage application, and so, we were seeking someone that we thought was going to be wise and have interest in us, and they didn't. And so
they didn't even want to meet you.
They never met me. But I want people to be treated with dignity and respect, and I wanted people to be treated like I wanted to be treated. And so was like the foundation of our company, just doing well for everyone and educating and empowering people.
And we were just very careful and conscious in our efforts to build a safe environment where people could develop and grow and have meaning in their careers that mattered to their lives. And
yeah, I mean, people, they were with us. Ed, our president, was with us for 30 years. You know, people 19, 20, 25, long careers.
We had an
us.
extremely low turnover rate,
We
less
did.
than 5%.
Yeah.
And which is huge. And in our entire career, no financial advisor who joined our firm ever left to go to another firm. We had a few retire, one passed away, but nobody ever left to go to another firm, which is, I've never encountered that in any other organization in the financial planning or investment management field. At many firms, the turnover is 25 or 30% a year, and ours is 0 over 30 years.
What we did was we gave people the tools they needed. We gave them a very healthy, happy, and safe environment to be the best that they could be. And I think that was the key to our success.
And we ended up being recipients of Best Places to Work awards multiple times from multiple organizations, and it was all very gratifying, and we had an awful lot of fun. But financial planning isn't all you're about. You have devoted your life over the past decade to a variety of subjects. One of them, where I'm a big beneficiary in particular, is macrobiotic cooking.
Yeah. So as you can gather from my weekly segments, I am about a whole lot of other things, homeopathy, Reiki. I just believe that there's so much more to this world. And then in college, I studied nutrition. It was intuitive to me, but then I guess 15 years ago was introduced to macrobiotic cooking. So macrobiotics actually dates back to the late 16th century, where an author, Christian Wilhelm Hufeland's book, The Art of Prolonging Human Life, it's dated 1797. And the principles are a plant-based, grain-based way of eating. But it's more than that. It's understanding a bit of traditional Chinese medicine where there are different seasons. So it's eating seasonally. So
give me an example of that.
Okay, so the summertime, all your fruits and berries are just beautiful and fresh. And so that's the time of year you would eat them versus the winter when you have more of your apples and your pears, and late summer you have your plums. And so if you watch, now we're so spoiled, we can get food from everywhere all the time, but in traditional Chinese medicine and macrobiotics, we go with the seasons. And so in the summer, we eat berries. In the fall, we do, like I said, apples and pears and different fruits. And then we switch up again in the spring and bring back
in the winter.
In winter, we do a lot more root vegetables, our carrots and parsnips and turnips, and so our root vegetables are more prevalent in the winter, and then in the spring we come back and we do all of our greens and our kales and our bok choys and different things. And so I have found it, because when you're eating with the seasons, it's creating more balance. We shouldn't be eating ice cream in December because it's cold out, and ice cream makes our body cold. We want things that make us warm and feel comfortable. And so it's understanding those principles of what food is and how it affects our bodies. And two gentlemen brought it to the United States, George Osawa in the 60s and Michio Kushi in the 70s brought macrobiotics more into the open. But then if you go back to Hippocrates, he says food is medicine and medicine is food. And so our food can heal. And if we're eating properly and understanding the balance and the seasons, that is helpful. But the other piece to this is I have always been about preventative. I'm always looking at our life. I don't want to run out of things, because then that's when the stress comes. So I'm always looking to prevent. And that was also a big piece of my health. And so I've always been very conscious of eating, but when my sister-in-law introduced me to macrobiotics because she had a health situation, then it was like this piece of the puzzle really clicked in for me. And so macrobiotics is kind of known as, if you're sick, this is what you do. But I see it as a preventative. I don't want the arthritis. I don't want the inflammation. I don't want the illness and the disease and the dis-ease in my body. And so that's why the food is so important. And so understanding the seasons and understanding how foods can affect our health is just so important. And I didn't want to go down my family's health path, which is a lot of heart disease and stroke and high blood pressure and arthritis. And you know what? I'm 63 and I don't have any of that. You know, we go to the doctor, we get all our blood tests, we have, you know, before I started macrobiotics in my 40s, I had a little arthritis. I don't have any. I mean, we shouldn't wake up with aches and pains every day. That's the goal. And so understanding how movement and breath and food can all help us stay in balance and have a healthy, you know, as the years go on. And it's so important. I just shared an article with you. If you can make some of these changes, and you and I, it's pretty plant-based, you know, beans and seeds and legumes and things, and we do eat fish every once in a while. But if you can understand this earlier in life, there's this study that just came out that you could change your life expectancy by decades. Even if you start it in your 60s, you can add 10 years to your life. And so understanding these principles and how food affects our health is huge.
And now you know why Jean visits us every week here on The Truth.
I'm a little passionate about it.
And Jean will be with us again next week, as always, right here on The Truth About Your Future. Thanks, Jean.
Thanks, Rick.
I know you can't get enough of Jean. Well, you can go to thetruthayf.com for more of Jean's Words of the Week.
Did you know Schwab offers a satisfaction guarantee? If for any reason you're not completely satisfied, Schwab will refund your fee or commission and work with you to make things right. You won't find that kind of promise everywhere, but you will find it at Schwab. It's just another way that they put clients' interest at the heart of everything they do. Learn what's included and how it works at schwab.com/satisfaction. That's schwab.com/satisfaction.
You're listening to The Truth About Your Future with Rick Edelman. Thanks for listening to today's show, and thanks to Bitwise Asset Management for being our sponsor. Rick asked Bitwise to support the show because Bitwise has just one mission: to help you understand and access the opportunities in crypto. As crypto continues to grow in scale and complexity, a trusted guide is more important than ever. That's why Bitwise has built a nationwide team of crypto experts to help you. So take advantage of Bitwise's team. They work closely with financial advisors, institutions, and individual investors just like you. Talk to a Bitwise expert today or sharpen your crypto knowledge with Bitwise's awesome library of content. You'll find great help whether you're a crypto beginner or a financial professional. Crypto has major risks to consider, including the loss of your entire investment. So before investing in crypto funds, visit bitwiseinvestments.com for their library of content and to learn about the risks with these investments. That's bitwiseinvestments.com.
Well, that's all the time we've got on The Truth About Your Future this weekend. Remember, sign up for my new master class, Financial Planning in the Age of Longevity. It's free at thetruthayf.com. That's thetruthayf.com. See you next week.
Bye-bye.
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 I'm sorry, what? What part didn't you understand? The buh or the bye? Bye-bye.
The Truth About Your Future with Rick Edelman has been brought to you by Global X ETFs, dedicated to providing investors with unexplored and intelligent solutions. And by Bitwise, a trusted guide in crypto has never mattered more. Connect with their dedicated team of crypto experts nationwide at bitwiseinvestments.com. And by Invesco QQQ, a fund that allows you to access the innovators of the NASDAQ 100. Invesco.com. Stay tuned for Everyday Wealth with Soledad O'Brien and Jean Chatzky from Edelman Financial Engines. Everydaywealth.com/radio. EFE and The Truth About Your Future with Rick Edelman are unaffiliated entities.
Get the truth about your future every weekend with Rick Edelman. It's thetruthayf.com.